Hey guys, welcome back. Yasin here. Today I want to do a different video. I want it to be more educational. It might be a little longer. I'm trying to help new traders out there who still collecting pieces of what trading means, and as you may know, like it does really have so many pieces and variables, and I wish it was school for it. So you'll know piece by piece and level by level. Majority of people they don't think that it's that way. I'm talking about like people who just start trading. They just want the best stock out there, and then they make profit or probably lose money, and that's it. It doesn't. I wish it was like that. It's not. So this video, I'm trying to collect as much information as I can, put it all together, have a good picture, a general idea of what's going on in trading, and then I hope you get something out of it. Okay. So trading. What is trading? If you want to trade, from my perspective, I've been trading for over 7 years now. I'm still learning, still making mistakes. You need to have an edge. So let's go ahead and start writing down things here so you can follow with me. So you need an edge, and what I mean by that is that you need to have a strategy. Strategy will include many variables. It will include money management. Okay, we'll go and explain each one of these. Okay, position sizing. Okay, and bear with me if I made a typo or spell something. What else? Position sizing. It will be stop loss. You need and way how to get an entry, how to get into a stock, how to exit a stock, how to take profit, and you need to know you might have some exception to the rules. Okay, and you can add as many variables as you want, but these are the generals. I'm just trying to give the whole video. I'll just try to give a guidelines. I'm not going to go into specific. I like to I'm not going to take your hand and walk you through step by step, but I want you to do the work. Nobody done the work for me. I did on my own. I wasted and I lost money and time. So I want to help you, but I think if I take your hand and go with you step by step, I think that's not going to be learning. Because if you really want to learn how to do trading, if you're really serious about it, I think you're going to have to do your own due diligence. And at the end, trading, from what I understand, you're going to have to come up with an edge and strategy that fits your own personality. You might buy somebody else's course, you might hire somebody, but at the end you're going to find out, this is if you're serious about trading, you're going to find that you're going to have to tweak that strategy to make it fit your personality. Okay, so I'm just trying to guide you and help you from here, and then you can add more to it, read more, which I really do encourage you to do more, because it's not about, even if you hire somebody, like I said before, you really need to do a lot of practice, and you need to go through so many phases of the market: bear market, corrections, psychology, man, this is a big one, mindset, discipline. We'll try to touch on some of these before. Anyway, so you need to have to go through so many of these stuff before you end up making your own general idea and making an edge and have a strategy. So I hope you get the idea. So you need to have an edge, you need to have a strategy, and strategy will include all these variables. You don't have to put real money when you're just starting to learn trading. You can use fake money on one of those platforms, any broker platform. Excuse me. You can even, if you don't have a broker yet, you can just put a trade. You need to have a chart. You can go to like the one I use, freestockchart.com, or you can download TC 2003. And then you just need that's the first thing you need to have a chart, and then you can put, if once you start developing your strategy, you can just put those trades on on a piece of paper. It's like, oh, I bought this day, this is how much I bought, this is my entry, this is going to be my stop loss, and you go from there. So you really don't need to have a lot of money. Once you start having an edge, you start developing your own strategy, once you are in the process, you can put some money to work. It doesn't really need to have a lot of money. I think the difference between making $1,000 or $10,000, you need to have that edge first, but the difference is you're just adding capital. So once you really have that edge working in place and you back tested it, and it's really making you money, so the only difference is just add more money and you'll go from 1,000 to 10,000. So it really doesn't matter. What matters the most is you need to have that edge, and you need to have that strategy that you really gonna follow no matter what phase. We're humans, we're gonna make mistakes. Sometimes we're gonna get out of those. We're not going to be disciplined, but majority of the time, like 80% out of 20, you're gonna follow that strategy. Okay, so money management, like I said, you can have it once you start developing that strategy. You start with $500, $1,000, but this is what I want. This is not what I want to talk about. What I really want to talk about is having that $1,000. You want to split it. This is something that I did not know at the beginning, and this stuff actually nobody really talks about. You just, majority of the time you will hear about pullbacks, you need this moving average, is stochastic, this and that, but when it comes to real trading, you need to know how to manage your money. For example, you have $1,000. How are you going to manage that $1,000? How much you going to put in that trade? Reading articles, reading vlogs, reading people's tweet, watching videos. When you just start trading, like I said, you can do paper trading. Once you feel a little comfortable, you can even, from that 1,000, you can just do 1%. Okay, 1% out of that. You can risk 1% out of $1,000 to start a trade. Okay, once you go and start being comfortable, you can raise that 1% to whatever you like, to your risk appetite. I have seen people, they go to up to 10%. For example, once you start really developing your strategy and you have everything in place, they go to up to 10%, and that will vary. Some people, when they really get comfortable and then you have a confirmed uptrend and the market is bullish, some of them, they go really concentrated, and then they go up to the 20% or even 30%, which I really don't recommend when you just start trading. So like I said before, just do paper trading, use some fake money, and then once you get comfortable, you start putting your own money, 1%, because you really, even when you develop that strategy, and if you don't really put that hard money to work, and you don't see it, and then you start having that interaction, and then the discipline, you're gonna see your heart start beating. Oh, I'm losing money in that. I think if you don't have that, if you don't put your real money to the market, I think that's not really learning. You see, so you start learning by putting your real money to work. But anyway, you get the idea. Position sizing, probably that will be within the money management. Once you have that 1%, you do the math. You take 1% out of $1,000. Oh, well, actually, this is $1,000, not $1,000. You take 1% out of $1,000, which is $100. And then you do the math, how much you find the stock that you want, and then you see how many shares you're gonna buy, and then so this is gonna be for shares, how many numbers of shares, and then you go from there. And then after that, you will decide how much, what is gonna be your stop loss. Again, stop loss, from what I've seen, if you read Williams O'Neill book, if you read Weinstein's book, which I do really recommend you to read. Let me see if I can pull them out here so I can give you an idea. I think probably you know them. William O'Neill book, How to Make Money in Stocks. Let's just put it, How to Make Money. I just want to show anyway, the book's gonna be books how to make money in stock, and the other one I think is Weinstein. I think I forgot how to spell his name. Let me see, let me Google it first and see. I think, yeah, it's Stan Weinstein's. These are really books that really did help me out a lot in trading. I do really recommend them. So these are the books you wanna really learn and you wanna study. Anyway, from those books, and yeah, I found that put in 8% stop loss. I think it's the max. You don't want to be losing more than. So out of that 1%, $100 that you put into that trade, you don't want to risk more than 8%. For me, as far as I'm concerned, sometimes I go even less than that, and I start going between 6% and even sometimes 2 to 3%. Okay, so that will be along the way, once you start knowing, once you start finding an edge, once you start finding good entry risk to reward ratio, you will get there. But again, as a general guide of rules, you don't want to risk more than 8%, 7 to 8%. And then entryway, you want to this is going to be, again, from general idea, from courses that I bought back in the past, and I've seen as of today, even people start trading breakouts. Okay, you trade in breakouts, and that will include flat base pattern. Okay, flat bases, and or cup and a handle. Okay, and then many more. Okay, double bottoms or inverse head and shoulder. But you really don't want to make it complicated. You just want to stick to simple things. Okay, let's just keep it breakout, flat breakout, and cup and a handle. Okay, once you find out what you're comfortable with, what you like the most as far as entry, you're gonna have to find a way how to exit the trade. So exit the trade, we said before, your stop loss is going to be 8%. Exit again will include a taken profit. So once back in the days, I used to hold the whole position from the beginning all the way to the end, based on breaking and closing below some moving averages. So I used to do that, and then once I started getting more experience and learning a little more from traders that they've been in the market years after me or before me, I started breaking down the trade, or actually breaking down the shares into like 1/3, for example. And you take the first third. Once it hits a certain percentage, or it breaks down some, or close below some moving averages. So it really ups to you. So I'm just giving you again a general rule guidelines to where to take profit, what is going to be, your risk, what the exit is going to be. Okay, again, that the exit is going to be something that has to do with taking profits along the way, same as exit. And you may have some exception to the rules. Sometimes you always get into, you wait until you have a breakout, and sometimes you might get into when the stock gaps. So that will be up to you again. So you can have those rules sometimes. So I'm just saying you can have some exception to the rules. It's not always going to be like black and white, and this is really something important that I really learned along the way. If you have like a solid rules, like I'm talking about, like in general, there's no such thing that works with the market, that one rule, specific rule, that it's gonna work 100% all the time. It will not. I guarantee you that. So you have to flow with the market. You know, the market does not care about your rules and what kind of rules you have. You put the rules for you to stick with them, because along the way in your psychology and mindset, we're human, like I said. We kind of fluctuate. Sometimes we kind of like lean to get out of those rules, but you put those rules in place in the first place, just so you can stick with them. So at the time when you're in a trade, when you're like, man, I should do this, no, you go back to those rules and you stick to those rules, to those rules. Okay, that's why you have those rules in the first place, so you don't question yourself second time. Okay, so yeah, so these are overall guidelines and what do you need to have as far as strategy. You can also include fundamentals once you start learning. When I started at the beginning, I used to only lean on the technicals. Okay, only technicals. I don't even look at the fundamentals. Along the way, and I think if you read Williams O'Neill book, How to Make Money in Stock, he does include technical and fundamentals. Okay, so, and I never really liked looking at the fundamentals until I think recently, last I think year or year and a half, I started implementing fundamentals. But I'll tell you one thing for sure: I will never buy a company that has great fundamentals and weak technicals. I would rather buy great technicals and kind of slight weak fundamentals, but I will never do the other way around. Okay, so that's me again, and that's from my perspective. Some people, like investors wise, that they put the money and they wait 10 years, 20 years, 30 years, they'll look at more on the fundamentals, which I don't blame them. I mean, yeah, you're not gonna if you're investors and then your stock just broke below the 50, that's not gonna matter, you know, because you're looking for the long view. Yeah. So, but again, me, I used to. Now we're trying to combine in both of them. You know, you have like you have two factors. Why not use both of them instead of using one? Okay. So and then the fundamentals will include. I don't really go deep down as far as I'm concerned. I don't go deep down on the fundamentals, and I just look at the EPS. How many look at stocks that do performs or keeps at 25%, at least 25% on each quarters, and then I look at their sales, and they have to be at least between 30% to 40% or up. This is like just the begin. This is just like a minimum for me when I look at the stocks, and I found good fundamentals, and then I look at the technicals also. But these are the minimum numbers that I really look at. Triple digit, they'll be really nice if they have triple digit. Okay, so these gonna be an edge. Just a general guidelines, just overview on what do you need as far as a strategy. So like you said, like you see here, it has so many variables that probably I missed something here. So I just want to give you overall picture of what's happening when I somebody or me saying, hey, you need to have an edge, you need to have a strategy. All right, so I hope I didn't miss anything here. We might come back to it if I miss something. All right, next thing I want to talk about is buying. So let's say you have an edge. Okay, let's say you got all that. You need to have a market that it's in uptrend. Okay, so you need a market needs to be in an uptrend. Okay, and William O'Neill has a rule of what's called a follow through day rule. They call it FTD rule, follow through days. That means if you don't know what follow through day rules, again, I will suggest that you go to here to Investors Business Daily. I use their website. I'm not getting sponsored. I'm not getting paid. This is just a disclaimer. I'm not getting paid. I use their service. But you go to the investorbusinessdaily.com, and then you go to the research up here, and then just put follow through day, and then first result. I want you to read upon it. Anything that I mentioned on this video, please do your own research. I just want you to learn more, and I'm just want to give you like the beginning of it. I just want to help you start and then go from there, expand your knowledge. Because as far as I'm concerned, my learning went a lot better when I started seeing many perspectives, many opinions. Always learn, even if something that you're against or disagree with. Learn it. Just give it a chance. And just so you won't be biased all the time. Okay. And that's one thing again in trading. You don't want to be biased at all. So go to Investor Business Daily, put a follow through day, learn from it, and I'll try to give you a brief explanation what follow through day rule. So basically, when the market is dropping, this is chart dropping, and then all of a sudden it make a low, and then it kind of almost like reversed up here, and then it made a low, and then we kind of break above that low, so you have a higher low. So that right there is follow through day. Okay, and then if I give you an example here, we kind of had a let's say right in here, last correction that we had, you see I'm flagging it in here. I was explaining it to somebody. So we had a drop from here all the way here, and we're trying to have follow through day. So the follow day through is that day right here. Okay, so we went up here, we came down, and then we broke above the high of there. So we made a low. So this is the first low, and then it needs to be. It doesn't really needs to be on volume. It's preferable if it's with volume, but hey, it's right there. That follow through their rule. And that follow through doesn't mean that follow through their rule. That day doesn't mean that the market's gonna go up 100%. Nothing's 100% in the market. No matter what rule you have, it's not, like I said before, it's always grayish. There's no solid rule in the market. So if that day follow through, it might fall. You might see stock comes back and start closing below it, and then what do you need to do? You have to wait for another follow through their rule. Back in, if you do some research in a chart, excuse me, you will find a bunch of follow through their rules. And if you go back to 2008, all those bear markets and correction, you will find that the stock did not respect the follow through their rule, and then it failed a couple times before it have a really good solid follow through their rule. Okay, let's continue. So that's the follow through the rule. So what you have a market that was in correction or bear market. So you need to wait for market to go on uptrend. In order for you to have a market and uptrend, you need to have the follow through the rule. Once you have the follow through the rule, then you need to start looking for stocks that start having long bases or just simple pattern. Okay, cup and a handle. Let's go ahead and put it here. I'm trying to go by steps so you can have a good idea on what I'm talking about here. Again, all right. So once you have a confirmed uptrend, you want to start looking for stocks that acts better than the indexes. Okay, and so you're gonna start looking for flat bases. You might want to find cup and a handle. Okay, and then many more. I just want you to stick with very simple ones. Okay, flat base, that'll be just cup and handle will be enough for you as a starting point. So once you have that, start looking for stocks. Maybe you want to start putting little by little, not engage 100% with your capital, but tiptoe into the market until it really confirms that follow through the rule that it's active. Like I said before, it might fail okay. And then once the stock market it's confirmed an uptrend, and you want to start getting aggressive, hit that gas pedal, put more money to work, and then you're gonna refer back to the edge here, and then you're gonna start being disciplined when it comes to the position size, how much money you're gonna put in. And then again, it's not gonna keep going up forever. You're gonna have pullbacks. Again, that's something that you will develop along with your edge. Market's gonna pull back 10%. Okay, averaged 8 to 12, 15%, not more than 15%. So you want to start. You might having a strategy that shows you once you don't have no more flat bases and then cup and handles, you might consider again developing a strategy on pullbacks, start buying or adding positions to the pullbacks, okay, at the 21 or the 50 MA or EMA, whatever you like. This is simple moving average or exponential moving average, or the 50 moving average, for example. I use these moving averages, simple moving. No, I'm just giving you again just the general rules, okay. And then you will have, along the way, you're gonna have to start implementing selling rules, okay. What rules do you have? Do you want to hold the whole position until the end and until it start closing or breaking below some moving averages, or you want to sell something to the strength? You want to break down that position into like 3/3, like I said before. Here you sell a little bit here. Once it hits a certain percentage, like William Money, you'll find out that he said sell something to the strength. Once the stock you bought it at flat base and it start hitting that 20%, 25%. He recommends he used to on his own start selling some of his shares when it hits that 20%, because once the stocks hits that level or that certain profits, certain percentage, it will start consolidating and going sideways. All right, so again, you want to expand from here. From what I just said, go reads, develop, get your own perspective, see what's out there, and then go from there. Okay. So selling rules, and then once the market go, let's see. Why this is not giving me let's see, I'm sorry, I don't know why. Okay, this is not good. I think it's probably froze on me or something. Oops, we lost it. I'm sorry guys, I don't know why I just did that on me, but anyway, I'm just gonna make a new one, okay. Sorry about that. I don't know why it froze on me, but anyway, so you just connect the dots between that first one and second one. Once you start selling some to the strength, market eventually will come to a correction. Okay, so we have a confirmed. We went from confirmed uptrend, and eventually the market will correct. Okay, so from uptrend to a correction. Okay, let's just put a text correction or bear market. Okay, once you have that, once you start having a bear market, oh, look at how I wrote that correction section. Anyway, you get the idea. From uptrend to a correction or a bear market, you wanna be out in cash, completely in cash. I used to follow Mike Webster. He's one of those his strategist in IBD. I remember him saying that once you have he used to look at the 50 moving average. I'm going to give you an idea here. Once you have once the indexes start breaking and closing below the 50 moving average, like it did happen here, first of all, if it starts breaking below the 21, you don't want to be aggressive too much. You want to kind of reduce your exposure to the market, okay? And then once markets start breaking and closing decisively on the 50 moving average, you want to stop buying and put in money to work, and then until see what the market decided to do. Okay, so I remember that what he said. So this again, just a general rule, not something that it's going to happen all the time. We've been there is sometimes where the market it's not going in uptrend, and the market it's has been in or had been in a correction, and it's been trading below the 50. Sometimes it goes above 50, and you look for certain stocks, like I think I was looking at excuse me, I was looking at GNRC the other day, and I don't remember what time frame. I think it was here back in 2019. Let's say the 2019, back in June 6th, GNRC broke out of this flat base in the long base here. Let me show you. We had a long base here, we had a breakout, we have good volumes. So if you look back on the Nasdaq, for example, on the June 19, was that what day is to be specific, June 7th 2019, June 7 2019, see it right here. So the market was still below the 50. You'd be like, well, you told us that first of all, I didn't tell you anything. I'm just trying to help you here. The market once the index is below the 50, you want to be in cash. Of course, you don't know what's going to happen. You could have a bear market from here. You really don't know. And then the most important things in trading in general, you want to preserve your capital. So you're always going to have some money to trade. So you have to stay alive. So I know some traders out there who really don't care about what the indexes do. They look for individual stocks. If they're doing good, they just put money to the work. So you have the Nasdaq that it's below the 50 moving average, and it's been trading below the 50 for like a couple of weeks, and it's still, you're looking at GNRC, for example. I'm just giving you an example here. You'll find it that it did broke actually with good volume. So you don't really, so this is, I mean, up to you again. You always want to look in general, you know, look at the indexes, look at the FANG stock, look what's happening out there. You don't want to be having one rule, again, black and white. If this happens, it has to happen. This happens. No, I don't want you to think like that. I want you to just look at the other opinion, okay? So you get the ideas. Not because the indexes are below the 50, that means the whole market, the stock market, all the over 7,000 stocks they're not gonna do good. Of course, when you have again, let me pull this back here. When you have correction in bear market, you're gonna have let's see here. You're gonna have upswings. Let me write it down here so you follow what I'm saying. You will witness, actually, oh boy, just bear with me. You will witness up and down swings. So the market at this time, when there's a bear market correction, the market is going to be very volatile, and it's going to have an upswings in both directions in a violent manner. So, for example, if you're flat based, if you're a swing trader like me, or if you just look at that sweet term in the middle of a trend to make money, I mean, it's not going to work out for you when the market is in correction, bear market. Might as well just set your money, sit on the side, and wait for the confirmed uptrend again. So when there's a bear market, you're going to witness upswings. Your strategy is not going to work. And at that time, I'm not saying that you're gonna have to go ahead and look for a different strategy. You want to stick to that strategy that does work in a confirmed uptrend. You can short if you want. I've seen a lot of people that they make majority of their money in their career trading career time when they just going long, not even shorting the market. What else? So we said uptrend, correction, bear market. You want to sit on the side. You can short the market if you want, and then from there again, the cycle will turn. And then what's your job is to wait for that follow through day, just to have a confirmed uptrend that we talked about way at the beginning. You have that follow through day rule. And if it's confirmed, then you start looking for stocks. Start looking. Let's go back here. You start looking for stocks that acting better than the indexes, or did not correct as bad as the market. When I say the market, I mean it's like indexes, okay? And then from there again, you get the idea. We're rotating back to the cycle that we started before, back to that edge rule, and then having that strategy and having that mindset that's gonna keep you again in the stock market. All right, so I really do hope you get something out of this. For those who just started trading, it's gonna take time. It's gonna take a lot of practice. Even if somebody, like I said before, even if somebody, if you hire somebody or you bought somebody else's course or the strategy, it's not gonna work. It's not gonna work like at starting next day, man. You have to put a lot of practice and a lot of charting. You're gonna have to do a lot of work if you're really serious about trading. So I really do hope that I did include everything here. I just want you to see the whole cycle. I don't know if I'm missing something here. You're gonna have corrections. Did I say it here? Well, yeah, corrections here. Start looking for stocks, taking profit. Take profits, and then until the market start breaking down. Okay. Correction again, bear market. You will witness draws, follow through there. And I just want you to see the cycle, because for me, back in time, I used to trade breakouts and cup and handles and some basic patterns, and then I didn't know back then that I didn't know the phases of the market. We're gonna have correction, of course, but I used to say, oh, if market is in correction or bear market, well, I still have to look for flat base and breakouts and cup and handles. But most of those flat base and breakouts, they're not gonna work. You're gonna have failed breakouts. You're gonna have stocks that you're gonna have some good bases, and you're gonna have breakouts, but they're gonna fail on you. So majority of them, they will not work. And I start taking a lot of hits back in those bear markets and correction. I'm like, why this thing is not working? Well, you are in phase of correction or bear market, so it's not gonna work. So you just want to sit back tight, or you can short if you know how to short. Even though short trading is a little hard, if I just started trading, if you are just start trading, I would suggest just sit back and relax and watch the market do its thing. Make your money, most of it, when there isn't a confirmed uptrend. So yeah, back then I used to my profit curve used to go up high, and all of a sudden we start having a correction in the market, and I start getting my learning, my profit curve used to go down, and I used to question myself, like, why does this breakout thing doesn't work? Why? Because they're failing, because you are in a different cycle of the market. So I didn't know that back then, and I start jumping from shorting again and from system to an edge to a different strategy, which is really not good. Just learn something, master it, get really good at it, and then you might tweak it along the way. Your strategy or that edge has to go through many phases of the market. Your discipline, you have to have patience during those phases. Many people who've been trading on the 90s, they've been making a lot of money back then when we had really good bull market, and all of a sudden people start getting comfortable, and when the dot-com bubble hits, and the market start really breaking down, people like they lost their pants, man, back then. So because they didn't either, probably they just start trading in the middle of that bull market, or they haven't been going through so many phases of the market. So it's really important. So yeah, that's really important on the when it comes to a strategy and edge, and know and have and live those cycles of the market. So I really do hope you guys get something out of this. Probably I did miss something. I'll be talking, if I sit here, I'll be talking like for hours. I didn't really prepare for this video, so my apologies for not preparing really well. If you guys have any more questions, if you want me to talk specifically more about something more, I'll be happy to do it. As far as I know, if you guys know something that I missed, please include it in the comment, or just mention what you guys liked and didn't like. So this is more educational video for somebody just started trading. I'm just looking at myself back a couple of years ago, and I wish somebody would have done this to me. Somebody would have told me, hey, split your money to 1% until you get really good at trading, and then increase the 1% to 2%, and then go from there. Which is really another important rule. Like, you start with 1%, and then you seen results then go to 5%, then 10%, and then start looking at your previous trade, which is really another point that I didn't mention. But this has nothing to do with this. I'm just showing you a cycle here and what's going on. The really important factor is one is with every quarter, or every month, or every single week, or every time you close a trade, go back and look at it, see what was your weaknesses, what was your strength on it. Okay, so again, I hope this was helpful. Give me a thumbs up if you guys like it. I really do hope you guys get something out of it, and I'll see you guys soon. You take care. Bye bye.